In this chapter 2, we review general notions of duration and modified duration before describing the duration model for the quantification and management of interest rate risk. Recall that a key weakness of gap analysis and of the repricing model is the extensive reliance on book value accounting, under which assets and liabilities are reported at amortized historical cost. This chapter presents the so-called duration model, which takes into account the market value of interest-sensitive assets and liabilities and uses the concept of duration to determine duration gaps rather than repricing gaps as the main tool for measuring interest rate risk. The duration model focuses on the impact that interest rate shifts have on the institution's equity rather than its net interest income under the repricing model, and so captures better the long-term impact of these shifts. Duration and its cousin, modified duration, are discussed in detail in our module Bond Fundamentals. We recommend you review this module if you need a refresher. We restate first the equation for the approximate percentage change of a fixed rate bond's price or similar instrument, such as an interest rate swap, as a function of yield shift and modified duration. The closed form formula for a fixed rate, option-free bonds modified duration is this, where n is the number of years, f the compounding periods per year, PV/CFT the PV of the cash flow for period t, and PVT/CF the total PV of cash flows under the bond, i.e. its price. The modified duration of a portfolio of fixed-rate bonds is simply the weighted average of the individual modified durations of each bond, the weights being based on current market values, as explained further in the formula appearing now, where n is the number of bonds in the portfolio, MDI is the modified duration of bond I, WI is the weight of bond I, which is the market value of bond I divided by the market value of the total portfolio, this relationship holds for both short and long positions. When the position is short, the weight must be set to be negative. The modified duration of the institution's portfolio of assets, MD asset, and the modified duration of the portfolio of liabilities, MD liability, can thus be calculated as follows. But we know that total assets equal total liabilities plus equity. So a change in the value of total assets, delta A, equals the change in the value of total liabilities, delta L, plus the change in the value of equity, delta E. Using our previous equation, namely that the percentage change in price equals minus the modified duration times the change in yield, we can therefore write the following for the change in assets and the change in liabilities. The change in the value of equity can then be calculated simply as this. And rearranging the terms leads finally to this expression here. The item between brackets is usually called the leverage-adjusted duration gap. It measures the duration mismatch between assets and liabilities for the institution. The larger this leverage-adjusted duration gap in absolute terms, whether positive or negative, the greater the institution's exposure to interest rate movements. Note also that we can measure the modified duration of equity as follows. Therefore, to measure the institution's interest rate exposure, we need first to calculate the modified duration of its total assets and liabilities. We remind you before proceeding further that from a risk perspective, and to calculate their modified duration, floating rate notes or bonds are equivalent to zero coupon bonds with maturity equal to the next interest rate reset date, and with face value equal to the principal plus 1 period of interest based on the most recent LIBOR reset. We refer you to our module on value at risk if you need a refresher on this point. We now illustrate the above concepts on this worksheet Simple BS, which is based on a simplified FI balance sheet. Here the FI has assets and liabilities with tenors ranging from overnight to 5 years. Each item has a simple description underneath it that specifies its tenor and the characteristics of the coupon or interest rate attaching to it. For simplicity, we suppose that all interest rate instruments follow the actual 360 takeout convention. Under demand deposits, we make an assumption regarding repricing profile that 80% of outstanding deposits are effectively core deposits with repricing tenor of 5 years, and that 20% of the total represent the volatile portion and are deemed to reprice overnight. We apply the same assumptions to the savings accounts, which we remind you typically pay a below market interest rate, assumed here to be 1%. Market data is summarized in cells J3, starting here, to P24. The future passage of time is broken down into 21 quarterly periods in cells J4 to J24. Except for the first period, which is set to 1 day only. The last of these periods thus matures in 5 years, which matches the longest tenor of the interest-sensitive items on the balance sheet. Relevant zero coupon rates are shown in cells M4 to M24. The day count convention again being assumed to be actual 360. Discount factors appear in cells N4 to N24. The 3-month LIBOR forwards appear in cells O4 to O23, while the 6-month LIBOR forwards appear in cells P4 to P22. Our module, Interest Rate Forwards and Swaps, can serve as a refresher of all these concepts and calculations. In the table starting on cell J27 down here, we calculate the modified duration for each of the assets appearing on the balance sheet. We first itemize in cells M29 to S49 the cash flows for each of the 7 items from the asset side, using, where necessary, the LIBOR forwards calculated previously. For example, asset 4, the 2-year consumer loan paying 6-month LIBOR, is slotted in the table in cells P29 to P49 as a 0 coupon bond maturing in 6 months and with face value equal to its principal amount of $80 million plus 1 period of interest based on the spot 6-month LIBOR appearing in cell P4. Cells M50 to S50 calculate the market value of each asset in the usual manner, i.e., as the sum of the present value of future cash flows discounted at the appropriate market rates, with the aggregate market value of assets appearing in this cell here, T50. In cells M51 to S51, we calculate the modified duration for each asset using the formula shown previously. Note our use of Excel function sum product. To shorten the steps in the calculation. In cell T51, we calculate the modified duration of the entire asset portfolio using the formula for portfolio modified duration we presented before. This reveals a value, as you can see, of 0.99. In the table beginning on cell J54, down here, we repeat the same process for the institution's individual and total liabilities. We make a number of observations in this regard. For demand deposits, we split the aggregate amount into a 20% volatile portion appearing in the cell M56 and an 80% core portion in cell M76. In both cases, the principal amounts are treated as face values of zero coupon bonds. Savings accounts are treated in a similar manner, with 20% as the volatile portion and 80% as core. The only difference is the 1% interest added into each formula, appearing throughout this column N. Cells M77 to R77 calculate the market value of each liability, with the total market value of all liabilities appearing in this cell here, S77. Then in cells M78 to R78, we calculate the modified duration for each liability, and finally in cell S78 over here, the modified duration of the entire liability portfolio, revealing a value of 2.3, as you can see. Note finally that the market value of equity, calculated in this cell S81, turns out to be 52 million versus a book value of only $20 million. From the market value and modified duration of total assets and liabilities, we derive, by means of equation 1, a modified duration for equity of minus 7.9. This modified duration of 7.9 means that a 1% parallel downward shift in rates would decrease the market value of equity by 7.9%. Similarly, a 1% parallel upward shift in rates would increase this market value by 7.9%. The magnitude of this potential change is significant, and the institution may be uncomfortable with such a high level of exposure to interest rate shifts. The question that therefore arises is how best to reduce this exposure, or even immunize the balance sheet completely to these potential rate shifts, thereby causing the equity value to become perfectly hedged against shifts in rates. This happens if the modified duration of equity is brought down to 0, for which a number of tools are available to assist in this task, interest rate derivatives prominently among them. We illustrate this via an interest rate swap. From a risk perspective, an interest rate swap is deconstructed into a long-short combination consisting of a fixed rate bond paying the swap rate and a floating rate note paying the relevant LIBOR. In our situation, the FI needs to increase its asset duration, which it can do by adding synthetic long-term fixed-rate assets via an IRS, and specifically by receiving fixed and paying floating under the IRS. Assume the FI receives fixed and pays 6-month LIBOR under a 5-year IRS. Our task is to determine the notional amount of this IRS that brings the modified duration of equity to 0. For this, we revert to equation 1, but include into it the IRS this time, leading us to this equation here that we now need to solve. Worksheet Simple BS with swap assists us in this task. Rows 1 to 79, of which we have hidden a very large number, are the same as in the previous worksheet, except for cells B20 to G23, in which we have added the IRS as an off-balance sheet item. We now input in cell D22 a guess of $100 million for the IRS notional, and in cell D23 a guess rate of 4% for the fixed leg. We need first to calculate the swap rate that reflects current market conditions, a procedure that was described in detail in our module on interest rate forwards and swaps. Cells M83 to M102 list the cash flows under the IRS fixed leg based on the guess in cell D23, while cells N83 to 102 list the cash flows under the floating leg. We have programmed the modified duration formula for the fixed leg in cell M104, for the floating leg in cell N104, and for the IRS as a whole in the cell O104. Note that for this purpose we have reflected the floating leg of the swap as a 6-month zero coupon bond, paying at maturity the notional of the IRS plus 1 coupon based on the spot LIBOR fixing, as explained previously. We now solve for the swap fixed rate via goal-seek, where we set cell O103, the PV of the swap, to the value 0 by changing our guess in cell D23 and hit OK, revealing in cell D23 a rate of 4.395%. The modified duration in cell O104 shows a value of 3.94, as you can see. Regarding the swap notional amount, we have programmed our previous equation in cell O107 for the modified duration of equity. Once again, we goal seek, setting cell O107 equal to 0 by changing this time the entry in cell D22, the notional, and hit OK, revealing in cell D22 a notional of 104,331,371. Thus, entering a 5-year IRS under which the institution receives 4.395% while paying 6-month LIBOR on a notional of 104,331,371 brings the modified duration of equity to 0 and hedges the institution against parallel shifts in interest rates. We mentioned before continuing 2 key limitations of this approach. First, the approach works best for parallel shifts in rates and less well for curve twists and pivots, since it centers around duration measurement, a concept built around parallel shifts only. Second, when the rate shift is significant, convexity appears and requires us to rebalance our hedge, often quite frequently and expensively. There is nothing special about using a 5-year IRS. Any other combination of IRS tenors is possible, provided we continue to satisfy the equations above. The optimal solution, therefore, may be to maximize positive convexity, a situation that is always beneficial, as explained in our module Bond Fundamentals, while reducing our costs from continuous rebalancing of our hedge. We have so far assumed that the FI wants to immunize its equity market value to shifts in interest rates. FIs are often more concerned with keeping the ratio of equity to assets at specified minimum levels. While this ratio is often based on book values, institutions increasingly calculate it from market values instead, a trend that has accelerated and expanded in scope since the advent of the credit crunch. We therefore amend our objective now to bring to 0 the sensitivity of the equity to asset ratio to shifts in interest rates, which we can write mathematically as follows. We will demonstrate that this occurs if the modified duration of total assets equals that of total equity. The proof depends on the so-called quotient rule from calculus for differentiating the quotient or ratio of 2 algebraic functions. As follows. Setting this equal to 0 leads us to this equation here, and therefore we need modified duration of equity to equal the modified duration of assets. To achieve this objective, we use once again the IRS that we used for equity immunization just a minute ago. We therefore revert to worksheet simple BS with swap, in which we have programmed in cell O109 the difference between the modified duration of equity and that of assets. And now goal seek, setting this cell to the value 0 by changing the entry in cell D22 for the notional, and hit OK, revealing in D22 a swap notional of $117,365,436. Thus, by entering a 5-year pay fixed swap at 4.395% and receiving 6-month LIBOR on a notional of 117 million, etc., the FI is able to guarantee an equity to assets ratio of 13%, irrespective of shifts in interest rates. The two caveats pointed out previously with regard to parallel curve shifts and convexity apply here as well, of course. We finish this chapter by stressing one important point. The use of swaps or other derivatives, whether with equity immunization or equity to asset ratio preservation, is a dynamic process. Changes in the constitution of the balance sheet will alter duration measures, which will require a rebalancing of notional amounts under the chosen derivatives. This brings us to the end of this chapter 2 and of part 1 of this module.